Ever wondered why the stock market behaves like a roller coaster ride? Well, let's delve into this intriguing world. Picture the stock market as a vast, unpredictable ocean, with waves representing the constant fluctuation of prices. It's not just random chaos, though. There are forces at play here. Economic indicators such as employment rates, inflation, and gross domestic product act like the wind, pushing and pulling the market waves. They give us a glimpse into the health of an economy and can trigger tides of buying or selling. Then, there are the thunderstorms, geopolitical events. Wars, elections, trade disputes, they all can send shockwaves through our ocean, causing sudden and dramatic market changes. So while the stock market may seem mysterious and daunting, it's not entirely inscrutable. By understanding the influence of economic indicators and geopolitical events, we can better navigate its ebbs and flows. And that's what we're here for, to unravel the market mystery. Understanding these factors can help us navigate the market's ebbs and flows. Think of the market as a giant puzzle, where each piece contributes to the bigger picture. Now let's break down some of these puzzle pieces, starting with technical analysis. This is a technique used by traders to predict future price movements based on past market data. It's like trying to predict the next move in a chess game by studying previous games. The key is to identify patterns and trends that can indicate where the market might be heading. Next, we have fundamental analysis. This is a method used to evaluate a company's intrinsic value. It's like being a detective, scrutinizing a company's financial reports, management quality, competitive advantages, and more to determine its true worth. If the current market price is lower than this intrinsic value, it may be a good time to buy. But the market isn't just influenced by individual companies' data. It's also swayed by macroeconomic factors. These are broad economic conditions that can impact the market as a whole. One of these factors is interest rates. When interest rates are high, people are less likely to borrow money, which can slow economic growth. Conversely, when they're low, borrowing becomes cheaper, potentially boosting economic activity. Then there's inflation. This is the rate at which the general level of prices for goods and services is rising. Mild inflation can stimulate spending and investing, but too much can erode purchasing power, potentially leading to economic instability. Lastly, geopolitical events also play a critical role. These are political occurrences that can impact international relations, and thus, the global economy. Events like elections, wars, and trade disputes can create uncertainty, often leading to market volatility. All these elements, technical analysis, fundamental analysis, and macroeconomic factors, are like keys to understanding the market's complex language. They help us piece together the market puzzle, giving us a clearer view of the bigger picture. These tools can help us decipher the market's complex language. So, how do we connect these dots to understand the market's mood? Well, the first step is to focus on economic indicators. These are statistics about economic activities that can give us a snapshot of the economy's health. Think of them as the pulse of the market, telling us whether it's strong, weak, or somewhere in between. Next, we have technical analysis. This is a method of evaluating securities by analyzing statistics generated by market activity, such as past prices and volume. It's like reading the market's diary. It tells us what the market has done, and from that, we can infer what it might do next. Then there's fundamental analysis, where we examine a company's financials and industry position to understand its true value. It's like peeling back the layers of an onion, getting to the core of a company's worth. Lastly, we must consider macroeconomic factors. These are events or trends that affect the entire economy and, in turn, the stock market. They are the tides that can lift or sink all boats. With these tools, you can begin to decode the market's complex signals. Now that we have these tools, what does the future hold for the market? As we gaze into the crystal ball of market trends, a few key themes emerge. Firstly, technology and innovation continue to drive growth. Companies that adapt and innovate are likely to outperform those that don't. Secondly, geopolitical events remain a wild card. From trade wars to political unrest, these events can cause sudden market shifts. It's crucial to stay informed and react quickly to these changes. Thirdly, we see the continued importance of sustainability. Companies that prioritize environmental, social, and governance factors are increasingly attractive to investors. But remember, these trends are not set in stone. The market is dynamic, always changing and evolving. Staying informed, adapting to changes, and making educated decisions are your best weapons in this ever-changing battlefield. So as we step into the future, keep these tools at your disposal. Remember, The market is a complex beast, but with the right tools, you can tame it.